Hi everyone, welcome again to this live event. As you know, every week I make a short review of what we could expect for currencies, both technically and fundamentally. So let's start by taking a look at the calendar, okay? Here we are, give me a second. Hope you can see it fine. As you know, of course, I forgot to mention that actually, as it has been happening ever since the year started, the market is trading mostly on sentiment, albeit economic data usually helps the case or interrupts the case in some circumstances, but the main market driver continues to be oil, right? We had a brief pause last week at the beginning of last week, and the quickly all of a sudden turned back to trading alongside with oil prices. The fact is that the background behind the latest oil decline from almost $100 a barrel to current $30 a barrel has not changed. The world has an oversupply of the commodity. Economic slowdown in China and now in the US suggests that demand will continue to shrink while stockpiles worldwide at record highs, historical highs. I believe that the latest data in the US is showing that stockpiles stand at levels not last in 1930, right? We're talking almost 90 years away. So the fact is that, as I was saying, the background has not changed. It's even getting worse and will probably extend into all this 2016, leading to some risk aversions trading across the world. Keep in mind that during this week, Chinese market will be mostly down because of a local holiday, the New Year, Chinese New Year, of course. And so the risk coming from that side has diminished somehow, but yet it's there, okay? It's just for a couple of days, but anyway, here we are with calendar, and I do believe that there's one main event this week that will probably rock the markets, and that is Fed Janet Yellen testimony before the Congress, right? In the semi-annual inflation report, he's giving explanations before the Congress, first one House on Wednesday, the other House on Thursday, about what's going on. Okay, it's missing in here, but it is. Anyway, Ms. Shalen is going to tell Congress how things are doing in the U.S. And the latest that we know is that things are not doing great in the U.S., that economic growth has slowed down by the end of 2015, and that slowdown seems to be extending into early 2016. So don't expect her to be nothing else but dovish, okay? It's how the market reacts to her comments and how dovish she stands that will actually move the market. Fed announced that they were willing to raise rates at least 4 times this year, right? And was sort of not an announcement, but something they suggested, right? The market rushed to price that in, and that's why the dollar got so strong at the end of the year. But ever since that is failing, there's a good chance that those 4 rate hikes will turn into 3, maybe 2, and even 1, right? One additional rate hike after the 25 basic points done in December. And that it's why we're seeing all the market rushing to unwin dollar both positions, right? Anyway, market will be looking mostly for clues on that. What we should say, how many rate hikes we have ahead, if chances have grown, diminished, or whatever. As I was saying, we're expecting her to be dovish, and if you take a look at what's going on around the world, the currency world has reached a new frontier, and we are having really dovish central bankers, with the exception of the Canadian one, right? All in line with easing and anticipating easing or making easy or leaving doors open for easing. So actually, a dovish stance will not be a real shock for the market. It has to be really, really dovish, saying, I don't know, something like, we are not planning to raise rates in 6 months or something like that to actually hit the greenback hard right this point, okay? That's the first thing I will take care of this week. Taking a look farther at the calendar, Okay, here we are on Thursday. Reserve Bank of Australia Governor Stephen speaks. Again, the same case, the central banker expected to be dovish. I do believe that the comfort level for the OC against the greenback for Governor Stevens is 17, right? So he's actually in his latest speech, he was actually saying that he's comfortable or how a weaker OC has helped uh, improving the economic developments. But for the most, he left door opens for a rate hike in the last week meeting and minutes. So overall, I will expect no surprises for Stevens. Anyway, he tends to move the market, and any change in his usual tone will probably produce uh, intraday spikes in the OC, either for good or for bad, during the Asian session. I hardly believe that he can, the movement that is generated by Stevens can extend, okay, into the European session. It usually reverses before the European session start, and if particularly if it's against the general market view, okay. For Friday, inflation in Germany and GDP readings also in Germany will probably move the market much more than lately because I was watching at the German calendar of these days, and we are having plenty of negative data. Things are keep worsening in Germany, and don't forget, Germany is the number one economy within the euro area. And if we see a slowdown in here, it will probably spread onto the region and therefore hit the euro further. Okay, so we are having really, really negative readings in Europe. I always say saying one swallow does not make a summer, but many swallows does, and that's what's going on with sorry. That's what's going on with Germany. We are having reiterated negative readings, and if inflation falls below whatever we're expecting, minus 0.8, right? That could be really bad for the euro. GDP is expected to be in line with most economies, pretty weak, at really tepid growth, 0.3% in Germany in the last quarter, and almost, whoa, I didn't notice this before, 0.0 growth expected, a downward review from the previous one in the fourth quarter, really bad growth. Anyway, retail sales for the US had been pretty disappointed last month. So if we have another negative reading, that will also weigh on the green. But anyway, let me change the charts and we can see what levels we can watch for today in the market, today and the upcoming days, okay? Give me a second. Okay, here we are. I'm sharing my charts. Here we are with the euro dollar. The pair is looking pretty bullish for me at this point, particularly after last week breakout higher. We have been range bound ever since December, January. The range has been shrinking. Finally, we broke higher, and here we are pressuring back the highs after correcting almost by the pip at 38.2% of this latest run. Okay, so my take for the euro is that it's bullish indeed, but I don't believe that we're going to see 120 or something wild like that. We have a major resistance level around 1460 level that has, give me a second, let me show you around there. If we go weekly, you will take a look at this weekly and see how the pair has been capped by the level. And since 2005 started, right? Early 2005, 1416 has been a key level. We have that wild movement in the Chinese Black Monday in August, right? It was, yes, it is, but it was not sustainable. It's less than 2 days. So 1460 is a probable bullish target and level to watch if you want to bet back on the greenback. Okay. Anyway, and for the shorter term, the pair is looking nice because what I'm seeing is that the technical indicators have corrected extreme readings reached last week and are back aiming higher. Although showing no actual momentum, I do believe that if we take that 1245, we can go up towards 13 today, particularly if risk sentiment continues leading the market. Keep in mind that when crude plummets and gold rises and Japanese yen rises. The euro also tends to rise against the usual because it's being used as a funding currency, okay? With negative rates, it's easy to borrow from Europe and invest somewhere else. Anyway, the main support for me comes at 11.45, which is the 23.6 retracement of the latest rally, and of course that 10.85 we reached yesterday, okay? I do believe that approaches to this level may attract buying interest. I don't believe that we can beat it with Chilean, even though if she's mill hawkish, which will be a surprise and has little chances of happening, right? Anyway, and for the pound, the fact is that the pound remains weak, right? We have that huge decline. We corrected up to the 50%, and we are back below the 38.2 and pressuring the last Fibonacci support around 43.50, which is the low we tested yesterday. So actually, I do believe that it's pretty weak. In fact, if you take a look at the pair, we are flat in the day, despite we had positive data coming from the UK today. Trade balance was better than expected, show a lower deficit. Import and export grow. Again, those import and exports grew was because of the service sector mainly, another sign that the UK economists are not doing good from the manufacturing side, right? So overall, I believe that in this particular case, and regardless whatever happens with the greenback, the bearish trend will prevail, right? And the spike will probably be seen as selling opportunities. If we have some dollar momentum of whatever, I do believe that it will probably strengthen more against the pound because it's the weaker. Anyway, and with the current chart and for the short term, I believe the 44.10 level is the immediate support. We have plenty of previous highs and lows around the level. If we take it back to 43.50, and honestly, if we lost this level, I'm seeing little in the way until 42.50, which is the next strong support level, okay? There's a lot of room in there for a trade. To the upside, we have 44.60, 70 as the immediate resistance. We have a spike up to there, but unsustainable. I would say that we need to take this Fibonacci level of 45.20, okay, 25 there, to confirm an upward continuation back towards the 46.60 region. But honestly, I'm not seeing enough upward potential in the chart to confirm that we can go even higher. Neither potential from the macro side, so I'm still bearish in this one, okay? The Aussie seems to have also corrected and big, right? And all of a sudden turned back south because of risk sentiment. When oil plummets, commodity-related currencies such as the Aussie or the CAD are the first to follow, and here we are. So far, the pair has been holding around the 70-20 price zone, but the risks remain towards the downside according to our charts. So I would say that a break below this lows, a bit below, and 10, 20, 15 pips below that Fibonacci support will be the key. As if we fail below the 70 mark, we'll probably resume the decline with more impetu, right? With more force, with more momentum. And we have the next probable bearish target around 69.40, okay? I'm not seeing much of an upside towards the upside, but we have a major resistance around 71.40. So I would like to see the pair opening up for a candle or bigger above this level to talk about a bullish recovery and a price run up to beyond this highs around 72.50. Okay, that's what I'm looking in here. But overall bearish in here also. Another one that's bearish, the dollar Japanese yen. Take a look at the weekly chart around 16, right? We had a major support. The pair has been holding above it ever since November 2014, over a year, right? And all of a sudden we have broke below it and moved towards 14.20 during the past Asian session, right? As stocks plummet and all. So this is my daily chart, and not only the price is extending its decline below the 1 and 200 moving average, but the 100 closed below the largest, and both gained bearish low. I know they are far away from the current level, so that means that this decline may be overstretched, but the pair has already bounced nearly 100 pips, and it's back under pressure and hovering around 15. I will take that 1590, 1620 region as the level to watch, because I will try to say to sell against this level. That's what I'm trying to say. Okay, sell against that level. And I believe that we have plenty of room to go further. The market was talking earlier today. There's a good chance that the Bank of Japan would probably intervene again, given that the Japanese yen appreciated that much. But the fact is that a couple of days, one was a couple of Fridays ago, right? And what? It was this candle in here. So we are actually 400 pips below the pre-interest, right? So I don't believe that this is the right moment to intervene again, because it would be worthless and would cost a lot in Bank of Japan. And if they have a bit of a brain, would probably refrain themselves from intervening, meaning that the market would probably push this pair lower, meaning higher. Okay, so looking for probably 16 actually for this one. Okay, I'm not seeing much more of a downward potential, and keep in mind that by the end of March, it's the end of the fiscal year in Japan, and usually the pair goes into that date with strength. The Japanese yen, sorry, goes into that date with strength. I'm not saying that it will appreciate further, because the laws of repatriation, of capital repatriations ahead of a year-end, fiscal year-end, have changed like 4 or 5 years ago. But anyway, the pair tends to go straight. So beware of a bearish February and a bearish March for the dollar Japanese yen. Okay, just something to take notice. It's not like if the pair reverse, you will keep on selling, but keep in mind that that 16 region will probably be the key, as if we need to recover firmly well above the level to talk about further gains. And even then, 18 seems way too far away, and a next level to consider that the pair may resume its decline. Okay, remember we talked about the probable that rounded floor in gold. Well, the rally has been extending and extending and extending, and we actually hit 1200 yesterday in spot. I can't believe my eyes, but we did. Gold continues to trade on sentiment and highly correlated with Fed, the U.S. Federal Reserve. Okay, diminishing chances of rate hikes this year is what keeping the gold in the bullish track, alongside, of course, with weakening oil prices. So keep that in mind, because if somehow the situation in the US reverse, and of course it will take more than one report, more than one statement from Yellen, but if the dollar reverse course and we saw a hawkish Fed and growing thanks and the economy recovering, well, that will be a sign that the bullish rally in gold is over, okay, and will probably revert. Anyway, at this point, seems we are going to correct slightly lower, because 1200 is a major psychological resistance level, but we can go down to 1176 or so, right, and around there, and without actually harming this upward potential. And I do believe that we are going to see more gains. We can move up to 1215, 1216. No, sorry, 1250 or 1260 this week. Okay, as long as the market sentiment remains the same. Okay, keep that in mind for those gold buds. And oil, it's actually doing little, right? It's not doing much, but it's clearly bearish for me in the daily chart, because we have corrected by point, right, by descent up to the 68.6%, and then we go back lower. We're struggling with latest Fibonacci support. I do believe that the main support now comes around 29.20. Okay, so if we lost that level, there's a good chance that the commodity will retest those lows around 26.60 or so, seen mid-January, right? And we'll probably extend the decline down to 25. And last week, one of my co-workers was joking about one of these days we're going to have negative prices in oil, right? And it was a joke, but it looks like we are not going to see any relief in the commodity, particularly because producers are pretty stubborn and are not doing anything to cut output or to fight this worldwide glut we are having with oil, right? I don't know. There was a meeting over the weekend between Venezuela and Russian, I believe, and Saudi Arabia. Venezuela and Saudi Arabia oil ministers, and they come out with nothing from that meeting. So it's clear that they don't want to reach an agreement to cut output, and as long as they remain in that stance, I see little chances of prices recovering, okay, even though the dollar is weak. And those rallies we see in the middle of the Swedish trend are probably profit taking ahead of risk events, or mostly that. So pay attention to those and look for fever levels and try to sell on those spikes, okay? Of course, with tight stop, because you never know when a trend is over. But so far, it's riding the wave in here, okay, the bearish wave, okay? Anyway, one thing that came to my attention today is the Swiss franc, okay? The Swiss franc has been losing ground against the greenback, meaning the pair has been going higher and higher and higher, despite the euro was in that range bound tone, okay? But today, all of a sudden, the Swiss franc is back under demand, okay? You can see that the euro is barely fighting its previous week highs, and in here we are at continued fresh lows, right? So we know that the Swiss National Bank tends to intervene in the market without saying so, right? They stay mute about their interventions. So what's going on in here is that they are probably stopping with their intervention, daily one, right? And the risk aversion environment, of course, is triggering some appreciation in the Swiss franc, and therefore dollar to Swiss is falling big, right? And that is putting some bullish pressure in the euro dollar, okay? So keep that in mind, because if we keep on breaking lower, if we lost this 28 level, there's a good chance that will help the case for the euro dollar recovery beyond that 12.45 during the coming hours, right? I'm not a big fan of trading a pair that or a currency that I know the central bank is quietly doing intervention. So I'm not recommending using or trading the dollar Swiss. Sorry, but you can take the euro dollar because they tend to move in tandem, okay? And for the crosses for the euro Japanese yen, I was following this sort of wedge we have in here. It was an ascendant figure, and all of a sudden we have break below it. If you take a look, if you remove the trend lines, sorry. Sorry, the fact is that we are actually bearish in here with the 100 simple moving average capping the upside and being the mere trigger of this latest bearish run. I'm looking for a 28.80 level. Okay, that's what I was looking past session. There we are. We tested during the Asian session. I do believe that if we break it back below that level, we have another 100. In another place, we have a 100 pips rally, clean, mostly clean, with not much in the way to trade. And in fact, I do believe that we can go down to 24.40, There, 22,440 is the main level, right? If we take this 28.40 today and the Japanese yen continues appreciating and the Bank of Japan remains sidelined, okay? Okay, I do believe that's it, guys, for today. Sorry, I have lost the grip to talking alone to my computer on a daily basis. It's it's something quite complicated sometimes. Anyway, okay, here we are. Here I am. It's not easy, but I hope you can get something useful from this coverage, and see you back next week. Okay, thank you and bye bye. See you soon, guys.